As the alarm bells sound on the urgency to build a new energy order, whilst balancing the need for pragmatism, the key investment priorities of investing in energy infrastructure to accelerate decarbonisation and electrification are focusing the minds of investment managers and capital allocators. Enormous sums will need to be raised and deployed to bring about these changes, and in the process, multiple investment opportunities will appear, with early movers potentially securing strong and profitable footholds. To explore this rapidly shifting landscape and its potential rewards and risks, the Money Maze podcast is delighted to welcome Anthony Catachanas, CEO of Victory Hill. Anthony, welcome.
Thank you, Simon. Thanks for having me.
So let's recap on your career journey. You have told me that you spent time amongst other firms, Credit Suisse and Goldman Sachs, which helped inform you in understanding business, whereas the later work you did at Mizuho honed your energy expertise. Is that too much of a simplification?
I think it's a very good summary, actually. There are, at Credit Suisse and Goldman Sachs, a few things that I picked up along the way, but Mizuho was certainly the culmination of some of those best practices that I've picked up and was able to put them into practice very quickly. I was given, actually, at Mizuho, a huge amount of bandwidth to try and challenge a few management concepts, resource management concepts, team building concepts that I had picked up at Goldman Sachs in particular, which to this day I view as an incredibly well-run firm. But at Mizuho, I was given a lot of leeway and flexibility to be able to, drive business the way I wanted to drive business. One of the many projects that I got involved in at Mizuho was really focused on energy transactions of a private capital markets nature. And this is where the origins of Victory Hill really start, is where we really came together across divisional fashion to be able to tackle certain specific situations in the energy market. And I was given at the highest level within the organization a bandwidth to operate across the wall and really straddle three divisions, from the commercial bank to the investment bank and the asset management firm, to be able to bring about transactions in energy for the benefit of some of the world's largest energy clients. And that really was the seed of the Victory Hill game plan.
So just help with the referencing of the conversation we're going to have about Victory Hill. Maybe you can just sort of talk about one transaction at Mizuho that sparked your realization of the opportunity and, was important for investors.
A lot of what we were doing was we were initially being approached by large global energy clients on a private basis to tackle situations that were of a balance sheet order, of a balance sheet nature. And so a lot of those, unfortunately, I'm not able to disclose, but I can allude to some of those activities in an indirect way. What I can say is that in some of those instances, we realized that there was a pattern of behavior from the large global integrated energy groups in particular. The industrial complex in energy is facing the reality of the energy transition. And the effect that that has on those companies and their business models is very simply that they have to adapt towards becoming a more asset-light, more P&L generating business, a business that is increasingly favoring commercialization routes and commercialization of different forms of energy and accepting the reality of electrification. And that simply means that when you look at an oil major, the oil major's ambition today in the 21st century is not going to be to pump more oil and gas out of the ground, but to understand how they can commercialize energy in an electrified world, otherwise said, becoming akin or more like utilities. And that is a very different game. So we were being approached by a lot of these players who had come to a seminal moment in the existence of these organizations. And in some cases, we're actually going back to their roots. If you think about some of the world's largest oil and gas businesses, many of them started their lives as traders. And many of them were thinking of how they can go back to those roots in an asset-light context. And what that meant was that we had to find ways to help them either divest assets and bring in institutional money to be able to do that, to help them facilitate that process and go to investors that wanted to buy assets that they wanted to sell strategically, or where we could enhance their ability to be able to commercialize energy more broadly.
So was there an electric light bulb moment when you said, Mizuho, great, but there's an enterprise out there that I want to chart myself?
Yes, we realized very quickly that this was a broader trend in the industry. But funnily enough, Mizuho was in a fantastic position to allow us to identify this trend in the first place. Mizuho is one of the three Japanese mega banks, a near $2 trillion balance sheet player, very active in the world of project finance, very active player in energy globally. And that global footprint meant that we had, a real global perspective on how energy was evolving around the world. So once we realized what the opportunity was, you're right, the light bulb came on. We initially approached the board of the bank to try and internalize this business, and successfully did. We created a group called the Energy Special Situations Group, which was a cross-divisional unit, P&L line of its own right.
So I understand the genesis. So let's talk about Victory Hill. Concisely, how would you summarize your mission?
We're in the business of accelerating the energy transition. That's literally what we do. The energy transition is a reality. We need to move towards a more sustainable energy system. And the global energy system at the moment is heavily reliant on hydrocarbons, and that needs to change. It's not sustainable. As we do that, we're realizing that all the initiatives that we've put forward so far, from the Paris Accord, COP21, to COP26 in Glasgow a few months ago, are all late. We're going to be late. We're not going to achieve those set goals because they're very ambitious, and we need to somehow find a way to accelerate the process. And that's what we're about. We're about accelerating it.
Well, I looked at, I have to say it's not a normal publication I read, but the BP Statistical Review ahead of this, and I see that the number is now 82% of the world's energy comes out of fossil fuels. So we know where we are on this journey. So can you distill your investment philosophy?
We strongly believe in particular in the middle market and the middle market's role in helping accelerate the energy transition. Philosophically, we come at it from the point of view that the middle market needs to be enabled, financially in particular, and needs to be enabled, being able to be given opportunities to grow, to expand overseas, and to really benefit from more of a globalization process, really, of knowledge. When you think of energy, I think it's wrong to think of energy in global terms. When you switch on Bloomberg, you switch on CNBC, not that these institutions, aren't reflecting the true reality of energy, but many speak more often of energy in oil and gas terms. So when you switch on the TV, you're hearing energy, and what people really mean is oil and gas. Today, energy really has a component of electricity, of power. Power markets actually matter a lot more. And the reason for that is because we are accepting a greater penetration of renewable power generation into the mix. And those things don't rely on oil and gas at all. They have no correlation to oil and gas whatsoever. The only correlation, arguably, is that the intermittency that these things unfortunately come with, i.e. when the sun doesn't shine or the wind doesn't blow, you don't get any power out of these types of generation assets. You then have to rely on more stable sources, and more often than not, those are hydrocarbons. But the point that I'm making here is that we need to recognize that the sustainable energy reality and the transition is a global problem, but one that requires local solutions. Every energy market around the world is different. Every energy market around the world has had its own reality, has its own mix, has had a very different history, very different development. The UK, we've benefited from the wits of Queen Victoria, who has helped industrialize the country and help electrify this country here. In the UK, this was the first electrified country in the world, as a matter of fact. And to this day, the UK is probably one of the most advanced and liberalized markets on earth when it comes to energy. So it is a bright shining light, genuinely, in the energy industry. But when you relativize that and you look at countries like Brazil, for example, while we have our historical realities based on the Industrial Revolution here in the UK and an associated reliance on coal, you look at the Brazilian conundrum, they don't have any coal. They have hydro, which is a renewable source, and about 120 gigawatts of hydro at that, which is about 65% of the total energy mix in Brazil. That makes them far more sustainable and ready for the 21st century than the UK is.
So I understand the big picture, this transition that's taking place. I understand the local character of these energy markets, which you've just explained. Let's talk about execution. lots of opportunities, lots of countries, same problems, different characters. How do you distill the opportunity set?
You need a team that has experience of having invested in energy over time. And you need to have had looked at energy for multiple decades. And we have members of the team that have been involved in the energy sector for nearly 30 years, that have seen, for example, the ethanol market develop in its nascent stages to where the ethanol market is to this day, that understand where and how the geothermal industry has migrated increasingly towards generating power from low temperature sources. And that is then, as a result, opening up the market and broadening it out. You no longer need to be on fault lines. To, for example, the development of different kinds of biomasses within the context of thermal generation that may be of a more sustainable nature, to this day, sustainable aviation fuels. Now, beyond the renewable power generation remit that all of us know and think we understand, which is predominantly in the minds of most solar and wind, maybe hydro being obviously the oldest form of power generation on Earth, we all think of things in a very simple way. There's so much more out there that needs to be developed. Understanding different local markets requires that you have that knowledge of the full spectrum and scope and breadth of different technologies, how they're applied, what trajectory of evolution those technologies are taking, and that requires you to have local experience as well.
So can we take maybe one example or two examples of either investments made in the funds that you're currently managing or being scrutinized, which you're particularly excited about?
We're a small firm, but we're a small firm of cross-border guys, cross-border transactors. We've been doing cross-border deals our entire careers, all of us. We speak multiple languages. We have more languages in this firm than we have people. We have more passports, as a matter of fact, than we have people as well. And the reality of having a diverse team culturally means that you can go into these markets and find and originate interesting deals. But there are a number of things that we do beyond that to originate those. We'll talk about that a little later. There are, for example, at the moment within the context of our strategy in the listed markets, we have about 24 assets in 4 countries at the moment. We run programs where we partner with operating partners. These are middle market developers that we partner with. We incentivize them to have skin in the game and co-own these assets, alongside us. We're a buy and hold strategy within the context of the listed fund. Within the context of our private equity strategies, we are obviously investing for growth and supporting the middle market developer to grow their business. I'm going to explain in a minute how these two things come together. But effectively, we have a global footprint. We're in the UK, Australia, Brazil, the United States, and we're going to be expanding very, very soon to other parts of the world. We're looking at markets in energy terms. We don't look at markets in economic terms. We obviously take that into account. But the most important is, what are the energy drivers? The energy sector is very unique, stands out in the economy more often than not, is a core sector, a core component of the economy, a core driver of inflation, so on. So one needs to understand the uniqueness of energy markets. That's very, very important.
So I'm an investor, I'm hearing this, I understand what you've said, it's taking me now to the bottom up. Let's talk about a case study just to really, shine the light on how you think about a transaction.
In the United States, for example, we acquired terminal storage assets. Terminal storage assets, a midstream asset, effectively. These are liquid storage terminals. The reason we acquired these assets was because we had been studying the case of the Mexican fuel market for quite some time. When you look at Mexico in 2013 went through an energy reform. It was the first time in multiple decades that a large economy and a large consumer of energy, the 6th or 7th largest consumer of energy in the world, as a matter of fact, decided to privatize their energy market completely. And as they opened up under a conservative government, they allowed, obviously, foreign players and foreign participants to come into the market. A lot of the core infrastructure within energy was still owned by state-owned agents at state-owned groups, including Pemex and the CFE. A lot of the refinery capacity, in particular in Mexico, was still owned by Pemex and was run. They have 6 refineries in the country. But more importantly, why was the refining capacity in Mexico important? Well, this is an economy that realistically still relies on fuels to a great degree. They're not going to turn into Sweden overnight. They're not going to enhance their grid system to facilitate electrification of the transportation system anytime soon. People use trucks, cars, and buses to get to work in the morning. Long-haul transportation is still heavily reliant on fuels. And the reality is they're still burning fuels of a high sulfur content nature, which we haven't seen in the United States or in Europe for the last 50 to 60 years. What we fail to understand is we haven't spoken, for example, of issues such as acid rain, which high sulfur content fuels cause. As sulfur goes into the air, it mixes with hydrogen molecules and so on, creates sulfuric acid, and that's what you get pouring from the sky, destroys crops and wildlife. These sorts of disasters, these issues, these climate issues, these emissions issues, are issues that we don't and haven't been speaking of in the public domain in our markets for a long time. And we forget that in other parts of the world, they're still facing these kinds of problems. So when we looked at the energy market in Mexico, we decided to try to figure out what the conundrum was, what the issue was. And they have a huge amount of backlog within the context of their refining capacity in Mexico, where they're unable to produce highly refined products. They produce at a surplus high sulfur fuel oil that has on average 4 to 2% sulfur content in it. The issue with that is because they can't use their own refineries to be able to break it down and produce more modernized Euro-compliant fuels or US-compliant fuels, they have to ship it up north to the United States. And so they exploit refining capacity in the US on the Gulf Coast predominantly. So if you look at those routes and how that business works, you understand that an aggregation point somewhere sitting in between Mexican refineries and U.S. refineries is a great thing to do because there is a reliance there on refining capacity in the U.S. The Mexican government's not going to be pumping in multiple billions of dollars to overhaul their refining system anytime soon. It's not a fiscal endeavor they want to undertake. And so they're reliant on that U.S. refining capacity, and we've acquired a terminal storage aggregation asset in the port of Brownsville in South Texas that literally sits right in the middle of that chain. We got into discussions to acquire these assets from a group called Howard Energy Partners, who were running a very large portfolio of midstream assets, pipelines, terminal storages around the U.S. Had been in the port of Brownsville for the last 4 to 5 years. They had a very, very good operational team. We managed to convince the operational team to come over and work for us, to kind of give us a view as well on the due diligence process, help us understand the assets, help us understand what every crook and cranny was within the context of the asset. Eventually made an offer to Howard Energy Partners to buy those assets out. And we acquired 2 terminal storage assets, which were small parts of their $3 billion portfolio, but that they had not, in our view, understood the potential of to its full extent. And we were able to then draw out more value from these assets by getting involved with an operating team that we constituted, built, put together, where we could leverage this asset and drive value for our investors. To this day, this asset is generating north of 19% IRRs, net unlevered, with leverage on top of these assets that are highly contractable, highly attractive for banks. You can look at returns north of 25%.
The focus, as we said, is on this transition and the essential role being played by renewables. So maybe we can just discuss the themes within renewables that are getting your attention.
That's a very pertinent question, very relevant and topical question at the moment. So there are a number of trends that are occurring. People want more renewables into the energy mix, but what they don't understand is really the ability for renewable energy to be able to support their need for energy. And what I mean by that is renewable energy and power generation in particular is intrinsically intermittent. And that intermittency is a problem. So when you add more renewable power generation to the mix, you have this issue of intermittency. The issue of intermittency needs to be resolved and counterbalanced by more stable, more reliable sources of power generation. To be able to do that, we need to look at evolving how these intermittent sources of power generation can be complemented with technologies that are non-invasive, that are sustainable, or rely on perhaps more traditional transition sources that are and don't have a negative effect from an emission standpoint or a negative effect from an environmental or social point of view. What we're doing in the context of our existing fund, our private equity fund, we're looking at supporting middle market energy developers by injecting capital directly into their balance sheets, doing what the majority of private equity firms don't know how to do. And the reason they don't know how to do this is because the sector has been frowned on for many decades. When you talk to most generalist private equity firms and you mention the word energy, it's such a niche sector with high barriers to entry, requiring such specialist knowledge that the majority of the participants in this market are people who come from the energy industry or who used to work in it or have participated in it over multiple decades, like Victory Hill, have an understanding in a more technical way of what the industry and what the technologies involved can actually do. What we're trying to do is we're trying to support middle market developers in energy with the knowledge and the experience that we have to be able to grow and eventually become leaders of tomorrow. And what that means is you're supporting a middle market energy group that, has ambition to develop a certain kind of technology, floating solar, for example, or develop battery storage or long duration storage using pumped hydro, for example, or gravity-based storage. We're supporting companies that are building microgrid systems and so on, which are systems in the evolution of the grid system and the evolution of a greater reliance on electrification are going to be necessary for different energy markets around the world. Distributed generation is also a theme that is extremely important in energy around the world. Distributed generation is the concept that you're really embedding generation and load centers or consumers together into one place, i.e. the consumer no longer needs to rely on the grid and the grid system. They can disconnect from the grid system and rely on their own captive sources of power generation and become independent, if you like. So that distributed generation system no longer needs to rely on the issues associated with age-old grids, for example. These are the sorts of technologies and themes that we favor in the energy world of tomorrow.
And what was the most recent transaction that you did in your private equity fund?
We have a lot of experience in distributed generation, for example, in places like Brazil. We've commissioned about 18 sites across 10 different states in Brazil of a geração distribuída nature, so distributed generation nature. The interesting case of Brazil is that Brazil has a very, very unique way of allowing and facilitating distributed generation. So distributed generation in its essence is solar rooftop panel, rooftop solar power generation, which you might see on a rooftop of a Walmart, a Tesco, an Amazon warehouse. The Brazilian version is very interesting because there are laws in Brazil that allow the distribution companies, the discos as they're known, to be able to help facilitate a net metering system. So if you are a consumer on the distribution company's network, you are able to sponsor and put your name, against a generation site that is somewhere else on the network that is not necessarily on your rooftop and get the benefit of getting a discount to your energy bill. It's called remote distributed generation. So you have groups, for example, in our case, we work with the groups like Telefonica, Raizen, and a few others, blue chip companies that have a need for getting discounts to their energy bills and want to achieve this by supporting the construction of power generation sites around the country in Brazil, in remote parts of the country in particular, where the distribution company has an interest in stabilizing loads basically for load centers and consumers, but more importantly, are able to make use of land and broader capacity to be able to help reduce those energy bills significantly for those other blue chip companies. So this net metering system is very unique in Brazil and helps these large blue chips be able to benefit from that discount to their energy bills, which are very high in Brazil.
And when you're operating in some of these developing countries and just a function of distance, how do you get comfortable with some of the operational and executional risks?
Eu falo português. Eu só falo português. So my mother was born in Brazil. She has made me very comfortable with a market like Brazil. But when you look at energy in particular, it's hard not to be comfortable with a market like Brazil. Brazil is probably one of the most advanced and largest energy markets in the world. This is a population of north of 212 million people, a very, very large population center, and a country and an economy that has relied on natural resources and energy in particular most of its modern history. When you look at the energy market today, it's been liberalizing since 1995. It's gone through a process of privatization in the late 90s. By 1998, they were modernizing the system and helping expand and build the grid system with the use and help and support of foreign capital, foreign companies. And they facilitated that process very effectively to build what is a very, very large and evolved and very modernized system. Today, they're liberalizing. And as they liberalize their markets, they're doing a few things that no other markets around the world are doing, because they have the ability of having a very unique energy mix and have the ability to be able to take this privatization and liberalization process to ends that we in Europe and the United States will probably never be able to do. What I mean by this is, for example, they are allowing participation in the free energy markets for retail consumers, which is a concept that is unheard of anywhere in the world. So the retail consumer will be able to buy and sell energy through a broker, through an assigned agent. You will be able to not go through a utility company as we do here in the UK or in the US or in other parts of the world. You will be able to go buy your energy directly from the market, from the free market. And that concept alone is very novel. That's how liberalized the Brazilian energy market is and is going. The reliance as well on hydro has meant that the market is so liberalized and so independent and modern that it doesn't need to rely too heavily on transition fuels like natural gas. It doesn't have a lot of participation of coal. It doesn't need to continuously rely on high sulfur fuel oil, for example, for power generation. Again, there's roughly around 250 gigawatts of demand in terms of energy. 120 gigawatts is provided by hydro alone. About 14 gigawatts is provided by renewable power generation, and the rest is a variety of other systems and mixes.
When we think about portfolio risk from a geographic standpoint, what would you expect to see in terms of the overall distribution by countries?
Our private equity portfolios are not blind pools. So we typically raised against a predefined portfolio. And at the moment, we've constituted a portfolio of very interesting companies located in France, Switzerland, Sweden, the United States, Canada, and Brazil. So we have about 6 companies that are all renewable energy companies that are really developing technologies for supporting either grid balancing or supporting energy independence for commercial and industrial consumers, or are facilitating an energy transition process in a more direct and accelerated way. That's the game plan. That's what we're trying to achieve. Again, that's our philosophy here at Victory Hill. So these companies are very defined. They're very clear in what they do. Some participate in, for example, things like the production of biogas. I mentioned before, some participate in microgrid systems, distributed generation, and long-duration storage, for example.
And investors who are looking at this opportunity, how should they think about the return profile?
The return profile is very interesting because these types of companies have a more accelerated development phase. So if you compare, for example, the development path for a particular technology or proving a concept in sectors like technology, IT or web development, think of a company like Google, for example, will need a long lead time to develop their concept. And so you have a J-curve effect typically in the life cycle of these companies before they meet, and they break even and they start becoming profitable. In energy, those profits come earlier. The J-curve is shorter typically. And what you end up seeing is typically IRRs that hover around the 25 to 30%, depending on where you are. These are all growth companies. They're post-revenue, post-proof of concept, obviously. They're starting to build up their earnings line, on their P&L statement. It's becoming they're starting to build a footprint. They have a clear path to expanding their footprint and becoming eventual market leaders. And in some cases already are market leaders. These companies are looking to return a multiple on invested cash of 3x in 7 years' time. A typical growth strategy, you'll appreciate, has a 10-year time span. We think we can do that in 7 years.
And do the dividends feature in your total return calculations?
There are some of these companies have the ability to pay out some income, but the strategy really is a growth strategy. Most of the portfolio will probably have dividends reinvested, really aiming at growth facilitation. We do think that there are features with some of these companies in the portfolio that can present early exit events.
You mentioned earlier on that private equity has been more cautious on the energy space. I was listening to Chris Hone, TCI, who has been on the show and is right behind the Say on Climate movement. He had a number of the amount of legacy energy assets held within the private equity space and the lack of scrutiny. What I want to ask you is, how do you think about the ESG credentials of your mission?
For us, sustainability is at the core of the transition. We're transitioning towards a more sustainable future. They're inextricable. You can't separate the two. Investing in a sustainable way in the energy sector is sacrosanct if you're true to the transition. So for us, we start with a series of United Nations Sustainable Development Goals as a lens to identify investments. And then we work our way through, that origination process in identifying which UN SDGs our investments are most compliant with. So when we're investing in a middle market developer, we want that developer to make explicit statements towards those United Nations SDGs and have those as a clear goal and mission for their business. A lot of sustainability investing has to do with understanding how you can draw and extract data and how you can really build data points of value. And this is where ESG factors come in. Governance factors are, intrinsic to private equity activity anyway. So it's really about environmental and social data that you're able to harness. Here, we've built a data infrastructure and a data management infrastructure that's quite advanced. We process a lot of our own data internally. We extract a huge amount of data from portfolio companies and assets, and we perform a lot of calculations and produce a lot of information for the benefit of our investors. There are reporting regimes out there for investors such as SFDR, such as TCFD, initiatives that are very, very important. And we want to adhere to those reporting regimes, and we do. The highest order in SFDR, for example, is Article 9. Article 9 categorizes funds in terms of how and what they disclose, as deep green or considered deep green funds. And they require you to align your portfolio to a great extent with things like the EU taxonomy, be able to disclose environmental and social impact data. And guess what? We disclose above and beyond those requirements. As a matter of fact, we have so much data and so much information that there's very, very little challenge from our point of view to being sustainability aware and impact aware in terms of how we invest.
So maybe we can talk a little bit about your current fundraising ambitions and the type of clients you'd most like to partner with.
We're an institutionally oriented business. We have an institutional background. We find that those that understand what we're trying to do are typically of an institutional nature. That said, we've seen an increasing amount of demand now within the wealth management community for strategies of this sort of caliber, more sophisticated strategies that try to tackle the energy transition in a more concerted, more targeted way. The listed fund that we launched really spoke to the majority of that community here in the UK, i.e. the wealth managers, again, the private banks here in the UK. We have appealed to a lot of them as a result. And I think in our private equity strategies, the private funds will be appealing to that community yet again. But we do have a core institutional client base that are following us, pension schemes, sovereign wealth funds that support us as well.
So you have an existing fund that you have raised around the investment trust, and this private equity vehicle has different aspirations and is going to hold a different series of investments. Ultimately, how would you describe and position this?
Everything we do here at Victory Hill is oriented towards the same goal, which is to help accelerate the energy transition. All the investments that we make here at Victory Hill are oriented towards supporting middle market developers in energy. In the case of the private equity fund, we're financing their balance sheet directly with capital so that they can buy and own that same infrastructure for the long run. We don't overlap developers between the two funds. There's a clear divide. So we're looking at a new developer cohort in our private equity funds and a different one to what we have in the infrastructure funds. But fundamentally, they're all doing the same thing, and they're all helping support the energy transition.
So what is absolutely clear after this conversation, Anthony, is that we are at a watershed in how we think and generate and invest in energy. And your approach to a private equity vehicle, your investment focus on these renewable assets and the opportunities is incredibly exciting. I'm reminded of John F. Kennedy, who said, "For time and the world do not stand still, change is the law of life, and those who only look to the past or present are certain to miss the future." So I've learned a lot from this conversation, Anthony. I wish you the best of luck on what is such an important mission and such an exciting opportunity. Thank you.
Thank you so much, Simon. Thanks for having me. It's a real pleasure.